$452, that is the gap between what gold costs in London right now and what physical buyers in Shanghai paid for the exact same metal today. Not a rounding error, not a data glitch, $452, and while the Western paper market just flash crashed gold down to a low of $4,319. The Shanghai Gold Exchange was sitting there pricing physical metal at $4,808. The same metal, two prices, 10.3% apart, and what that divergence is telling us about where gold goes next is exactly what this video is about. My name is John. I spent 15 years working inside currency and commodity markets before I started making these videos, and I have sat in rooms where these decisions get made. This channel, Currency Insider, exists to give you the same level of analysis the institutions are getting, built on publicly available data with every source named as we go. If that kind of calm, data-first breakdown is what you have been looking for, hit the like button right now. It tells me to keep making these. Last week I told you to watch the 10-year Treasury yield, specifically whether it held above 4.3% as a signal for dollar strength and pressure on gold. It broke above that level and closed at 4.39%. That call landed, and now here is what that means for everything that just happened in this flash crash and why the story is considerably more complicated than the headline suggests. Today you are going to understand exactly why Western and Eastern gold prices split apart by over 10%, what the Shanghai premium historically signals about the direction of Western prices, and how to use the 3 lanes framework this week to decide what it actually means for your own position. Spot gold's OR-US flash crashed to $4,319 in early Monday trading before stabilizing near $4,356, a violent move triggered by a hawkish shift in Federal Reserve language and the US dollar index rebounding to 99.72. When the dollar bounces and rate expectations shift hawkish, paper gold gets hit. That is not a new pattern. That is the same pattern we have watched play out multiple times over the past decade. The 10-year Treasury yield came in at 4.39% according to data published by the U.S. Treasury this morning. Rising yields mean rising opportunity cost for holding gold, which pays no income, so the paper sellers have a logical argument. But while all of that was happening in London and New York, the Shanghai Gold Exchange was pricing gold at the equivalent of $4,808, a gap of $452, 10.3%, the largest premium divergence on record for this cycle. Shanghai premiums can reflect more than just raw physical demand. Local import taxes, financing costs, market structure differences all contribute to the spread, and I am not going to pretend this is a pure demand signal and nothing else. But a 10.3% premium is not a local quirk, that is a structural signal that physical metal in Asia is being valued at a meaningfully different level than paper contracts in the West, and that gap matters. Imagine a car dealership in Manchester has the exact same vehicle listed for £20,000, while the identical car in Shanghai is being bought for £22,000. Some of that difference might be import duty and local taxes, but if that gap persisted for weeks and kept widening, you would start asking whether the Manchester price is being artificially suppressed by something that does not exist in Shanghai. Arbitrageurs, the traders whose entire job is to close gaps like this, would normally have closed it already, and the fact that they have not tells you there is significant friction in moving physical metal from west to east fast enough to equalize the price. Friction in physical markets, as the World Gold Council has documented in multiple structural reports, tends to resolve in one direction over time. The paper price moves toward the physical price. Not always, not immediately, but that is the historical pattern. When I pulled up the most recent Commitment of Traders report, managed money positioning in gold futures has been showing elevated net long exposure even before this crash, and that matters because when you have high net long positioning in the paper market and a sharp sell-off occurs, you get forced liquidation. These are not investors who changed their mind about gold. These are traders who hit margin thresholds and had to sell. Think of it like a tenant who put down a small deposit on a large apartment and the landlord suddenly triples the deposit requirement overnight. The tenant did not change their view on the apartment, they just ran out of room. That is what a margin-driven flash crash looks like. The selling is mechanical, not fundamental, and when mechanical selling exhausts itself, the underlying fundamental picture reasserts. If you know someone who has been watching their gold position this week and trying to make sense of what just happened, share this video with them right now. This breakdown took real time to put together, and the people who need it most are probably not searching for it. Central banks globally have been net buyers of gold for multiple consecutive years according to the World Gold Council's reserve data. These are not traders. They do not check price charts every morning. And when a central bank reallocates reserves into gold, that is a multi-year strategic decision. China's People's Bank has been among the most consistent accumulators in that data, the same country whose commercial buyers are currently paying a $452 premium over London, and those two data points, official central bank buying and record C premiums, are pointing in the same direction. For UK viewers, the LBMA is the pricing benchmark that bridges Western and Eastern gold markets, and LBMA vault activity and the AM and PM fix are worth watching closely this week as an indicator of whether institutional physical demand in London is absorbing or amplifying the paper sell-off. The Royal Mint has also reported elevated retail demand in recent quarters, mirroring what we are seeing in the C premium data at the institutional level. De-dollarization as a structural trend is a decade-long process, not a Tuesday event, and the US dollar index at 99.72, while strong in the short term, is still well below its multi-decade highs. The fiscal math in Washington, as the Congressional Budget Office has projected in its most recent long-term budget outlook, is getting harder to ignore. I am not saying the dollar collapses next Tuesday, but structural demand for dollar alternatives, including gold, is not going away. Gold's industrial use is smaller than silver's, but not trivial. It appears in semiconductors, medical devices, and high-reliability electronics, and Asian manufacturing supply chains, particularly in electronics, maintain physical gold inventories separate from investment demand. That supply chain demand adds a floor to Asian physical pricing that paper markets do not fully reflect. It is hidden inside products, dispersed across industries, and does not show up cleanly in any single data set, but it is real, and it contributes to why the C price has not collapsed even as London sold off. Lane 1, the paper market. COMEX futures just showed us a flash crash to $4,319 driven by margin liquidation and dollar strength, with the DXY at 99.72 and the 10-year yield at 4.39%, giving paper sellers a logical trigger. Positioning data from the CFTC suggests some of that forced selling has already occurred. Lane to the physical market. C premium at 10.3%, $452 over London, with LBMA vault activity worth monitoring for signs of institutional physical absorption. Royal Mint data showing elevated retail demand in the UK and physical buyers in Asia not panicking but buying. Lane 3 macro, Federal Reserve. Hawkish tone and dollar rebounding short term, but CBO fiscal projections, sustained central bank gold buying per World Gold Council data, and structural de-dollarization trends all point in a different direction over the medium term. When the paper lane is showing forced liquidation while the physical lane is showing record premiums and the macro lane is showing structural demand intact, the historical pattern has been that the paper price eventually catches up to where physical buyers have been pricing the metal. That is a framework, not a forecast. You decide what to do with it. Here is the one thing I am personally watching this week: the C premium, specifically whether it holds above 5% after this week's liquidity normalizes or compresses back below 3%. If the premium stays elevated above 5% by the end of this trading week, physical demand in Asia is genuine and sustained. Not a one-day technical anomaly. If it compresses quickly back toward 2 or 3%, the flash crash brought Western and Eastern prices back into closer alignment and the arbitrage window is closing. Watch for the C data Thursday and Friday this week. This is my one call for the week, John FX Insider, on record, and I will be back next video to tell you exactly what happened. No edits, no excuses. For the optimistic picture, gold needs to hold the $4,300 technical floor, and if it does, the C premium creates sustained arbitrage pressure that historically forces Western prices higher to prevent a drain of COMEX and LBMA vaults. Physical buyers in Asia do not disappear because of a Fed statement. They have been accumulating through multiple rate cycles, and the optimistic case says this was a paper-driven flush that creates a medium-term entry point for physical holders. For the cautious picture, a sustained break below $4,270 on COMEX could trigger automated trend following sell orders toward the $4,100 psychological level, and the honest caveat is that the C premium includes factors beyond pure physical scarcity, so if Chinese regulatory changes or currency moves are amplifying the spread, the premium may compress without Western prices needing to rise. Both outcomes are genuinely possible right now. Your job is not to pick one and emotionally commit. Your job is to watch which conditions are actually developing in real time, and the market will tell you which path it is taking. Before we close, everything in this video is educational content based on publicly available information. Currency Insider does not provide financial advice, investment advice, tax advice, or legal advice. Nothing here should be construed as a recommendation to buy, sell, or hold any asset, and past market behavior is not a guarantee of future results. Always consult a qualified financial professional before making investment decisions. That disclaimer is not a formality, it matters. If you got value from this today, the like button takes 1 second and genuinely helps this channel reach people navigating these markets without all the noise. I want 2 honest answers, not just a thumbs up. First, are you currently seeing physical gold premiums at your local dealer or broker that feel out of line with spot price? Tell me the gap you are seeing, US or UK, it does not matter. Second, do you think the C premium compresses this week or holds? Subscribe. Next week we are going into COMEX vault inventory specifically, showing you exactly how to read the CME warehouse report and what the registered versus eligible distinction actually means for physical market tightness. And if someone in your life is watching their stack right now feeling confused about what is happening, share this with them. This is Currency Insider. Know the market, protect your currency.